Hello team, welcome to this instructional video of how to use this cash flow tool that I have built. So first thing to note guys, this is very much just a prototype and I've built this over the last couple of days with a lot of your help actually. People have already been giving me feedback. The idea is that hopefully if you can continue to give me feedback about this tool, I can refine this over time and we can make this into something that is really, really valuable that everybody can use. So please do keep that in mind though. You should only really be using this as a rough guide to understand the trajectory that you're on. You should also know that whenever you are making projections that are 40, 50 years into the future, they will almost always be wrong. So really just only use it as a guide. Do not rely on this entirely to make financial decisions. And I cannot be held accountable for the accuracy of this. I've done my best job, but there might be some things that are wrong with this, and that's why I want your feedback. If we can have 1,000 eyeballs on this, then hopefully we can make this as accurate and as useful as possible. So whether it's accuracy, new features you want to see, something that's just breaking that you've noticed, please do continue to give me feedback either in the comments section of the video where you found this, or you can share your spreadsheet with me and you can send me an email and you can show me what's going wrong. That would be really helpful. I do appreciate that. And so many of you have already given me great feedback for this as well. So do not use this as a crystal ball. This is not a crystal ball. But the great thing that you can get out of this is really just playing with this. Firstly, putting in your situation right now and getting a good gauge for where you are right now, whether you're on track to achieve the things that you want, but then playing with it, looking at, okay, what if I did this? What if I do that? What if I work a little bit longer? What if I potentially start doing part-time work in retirement? What if I reduce the amount of retirement expenditure? You play with all these different variables and you'll learn a huge amount about what moves the needle and what doesn't, because things that you think will move the needle may not actually. So that's what I think tools like this can be most useful for, is really just exploring, investment risk. What happens there? The amount of money that I'm contributing, the date that I choose to retire, things like investment fees, all these types of things. Playing around with this stuff can really help you to learn how important each of these factors are and to understand there's actually lots of different ways that you could go about achieving your goals. So where it says here, for instance, that we're going to end up with just over £600,000, that's probably not going to happen. But what we can start to explore is what is going to increase our probability of achieving that goal, or what is going to make it even more likely that we're going to be able to achieve that based on the very sort of rough outline that we've created with this tool. Obviously, in this model, the big thing that's different is the fact that the returns are straight line. We're looking at real returns here of 4.24% a year every single year. We know that when it comes to the markets, they do not operate like that. So this is not going to look like the real thing, but it's just really there to give you an idea of the trajectory that you're on. And most importantly, to start playing around with things and to see how things change. So we're going to go through this section by section, so please feel free to fill in your information as we go through this so you can get a good understanding of what you should and should not be doing. So firstly, just starting off with the input tab, first thing you want to do, obviously, if you haven't already, is make a copy of this. Make a copy or download it. You'll have different options here because I'm the owner of this spreadsheet, but you want to make a copy of this and download it. Next thing you probably want to do is subscribe for updates. So you can click on this link here. It's just a Google Sheets form. Give us your email address, and then I will send you an email each time that we make an update to this model. We'd probably be doing one at least minimum each tax year because there's loads of assumptions and things that we need to change each year. But hopefully we'll also be making some feature improvements and things like that as well. So first thing to note here, throughout this model, you should only ever be entering information in today's money. So don't try and get yourself tied in knots around inflation and how much things are going to cost in the future or anything else like that. The model takes care of inflation. So please just only think in today's money. So first starting off, your age, pretty self-explanatory. Retirement target. So what this actually means is not a day where you're suddenly going to put your feet up and never continue working again. This is the date at which you think you might need to start drawing some level of income from your investment portfolio. Now, you may continue working, you may work part-time, there are maybe other things that are involved, and that's what you can enter in here, additional retirement income. But the idea is that this retirement target is really just a point in time where you'll think you'll need some level of income from your investment portfolio. So that's what this signifies there. Your liquid assets, current value, pretty self-explanatory. Annual contributions, again, how much are you contributing to each of these buckets each year? The only one that I need to talk through here is pension contributions. So this should be the gross amount that ends up in your pension each year. So that's your contribution, your employer's contribution, and any government bonuses, any government top-ups that you get as well. So this should be the full value that's going into your pension each year. Annual change in pension in contributions. This is so that we can just at a very high level make some assumptions of how your contributions are likely to increase over time. Again, don't think about inflation here. Really just think about, am I going to get a promotion? Am I going to start to get paid more? If my salary is going to be going up maybe sort of 2% in real terms each year, shall I be adding in another 2% contribution here? Or maybe can I add more in? Maybe I'll be adding more in there. So this is just going to then project how our contributions are likely to increase over the time up until the point of our retirement target. Once we reach our retirement target, all contributions stop, and then we just start withdrawing assets. So contributions stop when we reach our retirement target. The next thing here then is just investment risk. This is a really important one. You need to do a little bit of research, like in the third part of the video, to work out exactly where your assets are, how they're invested, whether they're invested in 80 to 100% equity. So equities means stocks and shares, or 60-40 or whatever. You change this up and it will give you different levels of return. And these are calculated automatically. Do not change these. Then coming down to additional retirement income. So again, this should line up with your retirement target. So I don't want to see any income figures in here that predate your retirement target. So here, retirement target is 55. So then the earliest, if we were going to start doing part-time work, is that we probably want to say, okay, retiring at 55, let's go for 56 as the first year, and let's say we work for 10 years, so let's go to 66 years, and I'm going to earn £10,000 a year, something like that. Just seeing what that looks like. So again, feel in to add in whatever you want here. When it comes to rental income, again, this should be net of costs, not net of tax. You should ignore tax in this model. It takes care of income tax for you. It calculates your income tax position each year, so you don't have to worry about that. Just make sure the rental income is basically your pre-tax profit that you're receiving from any rent. Add in any custom ones here. Again, if you don't have rental income and you want to add another custom one, feel free to just delete this and add your own custom one in. So the final part here then is expenditure. So what we've done is we've worked out, okay, what we need to do here is, what is going to be your total expenditure in retirement? What is your ideal expenditure that you want to achieve in retirement? And then what the model is going to do is going to look at, okay, so we want 40K a year for the first 20 years. And what we're going to do is we've got 40K here. We've then got, let's say we've got another 20K from part-time work. I need to then find £20,000 from the portfolio. So what it's really looking there is to look at joint expenditure minus any additional retirement income, gives us the deficit that we need to then find by drawing down assets from your portfolio. And again, this general expenditure should align with your retirement target. So this already does, it already is as set up here, so that it does change as you change your retirement target. But again, I don't want to see any expenditure in here that predates your retirement target. They should all align. And again, you can see how you can have different periods where you earn different amounts. Typically, I've just put this in here, a 25% reduction at 75. Again, feel free to change these up, to change these in any way that you want. These are all ultimately custom. You can change them. You just put in your starting age, end age, and income on retirement. So the only other thing then to note is, as you can see here, you've got partner section. So if you've got a partner, certainly fill in their assets, certainly fill in their position. It's very important that you don't just double up and put both of your assets in one, because it calculates tax. So if you've just lumped all your assets together, then it's not going to calculate the tax properly across the two of you. Just be aware that as you start to fill in these figures here, the graph might go a bit crazy, because until you've actually got all the information that you need, investment risk and all those types of things, the graph might look a bit mad. So just be wary of that. And then our output. So here you can see this is a stacked line graph, So we've got the total level of assets building up here. We can see that's going over just over 600K. And then what we can actually see is the individual figures of the underlying. So we've got green pensions, we've got ISAs, we've got other investments, and we've also got cash. And you can see how those are then drawn down over time. We'll go through the drawdown process and the sequencing with that when we go through our assumptions. So the thing to note here then is that annual change in contributions. So what we've done is we've just set up a way that you can very easily just model an increasing level of contributions over time. However, if you want to get into the nitty-gritty and you actually want to put in your exact contributions, or you want to model big lump sums, inheritances, selling a property, things like that, you do that on the second tab here, one-off contributions and withdrawals. So this looks really confusing because there's loads of numbers, but I'll talk you through it, so don't worry. Two sections, one for you here, and one for your partner here. Now, what we've got here, this first line, is your auto-calculated contributions. So you can see we've got pensions and ISAs here growing at 2% a year, here growing at 2% a year. So we can see how they're growing at 2% a year up until the point of you reach 54. The last year you make contributions, and then from 55 you are drawing an income. So if you wanted to, let's say for instance, you thought you were going to get a bonus and you wanted to top up your ISA in this year, you'd put £14,900 because it's going to add up that. It's also going to add up that, and it's going to give you your ISA contribution there. So just be mindful that it's also going to add up this. This does not overwrite this. This is on top of that. So if you did want to just do without these also calculated contributions and you want to put your own estimations in every single year, then you just got to reduce these to 0. And then you can see that we've got 0 here. So that's just not going to count them at all. But otherwise, yeah, this is really useful for putting in big lump sums. So for instance, you've sold a property. Let's say you sell a property for 200 grand, and then you top up your, so you sell a property for 200 grand. You then let's just keep this simple, £200,000, and then over the years, what you decide to do is then to start pushing this money into your ISAs and pensions. So you start putting in £20,000 a year into each. So you can actually only do here sort of around about 14,700 or something because you've already got that amount there. And then let's say we put £25,000 into our pension here, and then what we're going to do is whatever the sum of that is, 37,900, 30, and this has to be minus. So basically what we're doing then is we're just shifting the money around. We're just shifting the money from other investments, which is a taxable account. You're going to be charged income and capital gains tax there, shifting that into tax efficient vehicles like ISAs and pensions, which is often a good thing to do. So you can just mimic that. You could mimic that going forwards and say, okay, I'm going to do this every year. Obviously, you just got to be mindful of that these figures might change. And you can see how things are sort of changing over time here, where our other investments line is getting smaller and smaller and smaller as we are making withdrawals from that, and the others are getting bigger. So feel free to use this as you please for any lump sums or withdrawals. These can be positive and minus negative. If you're going to be making any big withdrawals, please do use that. So although this does look really complicated, it should actually be really simple. And I have to put these figures in here so that you can see, what the also calculated contributions are, and also what your year-end figures are, because it's also not going. If you say that you want to suddenly withdraw 200K out of your ISA, and you don't have 200K, I mean, it's going to go to 0, but that doesn't really work, So you just got to be mindful of that. That we shouldn't be doing that. The maximum you can withdraw is these figures here, so just be mindful of that. So yeah, that's it. This sheet done. This is a sheet where you can get into ultimate granularity and you can make it look exactly like your position. Again, all figures here should be entered in today's money. Please disregard inflation. So final tab, assumptions. Now, please read these notes here. It's not really a huge amount to go through. notes here, and then also just some limitations of the model. Not good for, I should probably change that to just limitations, but yeah, things it doesn't do, doesn't calculate pension lifetime allowance, and it doesn't limit your pension contributions if you earn over £240,000. And there's some limitations with the drawdown sequencing that we'll get onto very shortly. Again, with these assumptions, I have had a pretty good go at this. If you're unsure about these, do not change them. Just leave them as they are. But if you do have any strong opinions about these assumptions, if you think they're wrong, just change them. Just change them. This is why we've built the model like this, so that we can update these over time, or you can put in whatever. But also, you might just want to change them just to experiment, just to see what different things look at. Like, what happens if inflation goes up? What if my fees were to reduce? Things like that. So you can see we've just got the start current year. This doesn't change much. We've then got stocks, aggregate bonds. That's all it's doing. It's a very simple portfolio that we're calculating here. We're just looking at here we've got 80% equities to 100% equities. What this is doing is putting 90% stocks, 10% bonds. What is the actual return of that mix between these two? And that's the same here. So this is 70%, this is 50%, this is 30%, this is 10%. And then we've just got the real return here. So don't change any of these, only change these inputs here. Return on cash. That seems pretty generous. I mean, the thing to recognize here is that what I'm trying to do here is make 30-year assumptions. So that's why they don't look like today's figures, because we're trying to make an assumption of what is the average likely to be over the next 30 years. So return on cash 1%. If inflation is actually at 2.25% for longer, maybe we can increase this. But again, that's up to you. If you feel that you really want to make changes to this, please do. So tax wrapper adjustment. The only thing here is with other investments. So because the model is unable to calculate any income tax or capital gains tax that you might draw from either from dividends from these other investments or ISAs, or capital gains tax from when you sell. It's not able to calculate that because I don't know your income tax position as well. There's loads of things that I don't know here. So what I've done is I've just put in a little bit of a headwind, a -5% headwind. Again, if you think you're likely to pay more tax than this, increase this level. If you don't think you're likely to pay any tax at all, if the amounts that you're investing in this space are going to be within your dividend tax allowance and your income tax and your capital gains tax allowance, put this to 0. And then fees. This is something that you do need to do. So the third part of the video was all about making sure you understand what your fees are, how you're invested. So make sure that you've actually detailed all your fees in here, all your fees. Okay. If you find a fee and you think, okay, that's it, fine, I'm going to put it in. Or when you're looking at your pensions, that's probably not it, right? You're probably just looking at the platform fee. You need to dig in and find what are the platform fees, what are the product fees, what are the underlying fund fees, what are the total costs involved with investing, and chuck these in. Tax bands, don't change these. I will be making updates to these as we release new versions of this model each tax year. So yeah, the drawdown order. So this is far from optimum, but just to keep things simple, otherwise I would have had to spend many, many years trying to do this, is what order do we then draw down assets from? So what it's going to do is when we get to retirement, we're going to say, okay, we've got a deficit of 10K. In this year, we need to find £10,000. Firstly, I'm going to go to cash. I'm going to take money from cash. As soon as I exhaust cash, it's then going to go to other investments, then ISAs and pensions. And that's where you can see that we've got this sort of cash gets depleted first here, and then ISAs and then pensions. So that is far from optimum, but hopefully we can make improvements to this over time. The final thing that you need to know is define contribution tax-free cash. So the default assumption is that you do not take a tax-free cash lump sum. The default option is that you take it gradually over time. So what it means is that, let's say you withdraw £10,000 from your pension in a year, 25% of that is going to be tax-free. So we're only going to be calculating tax on 7,500 of that. And that's, I think, a good assumption to make. But if you want to model a tax-free cash lump sum, so let's say if you wanted to say, I'm going to then on my 55th birthday, I'm going to withdraw, let's say you've got 400K pension, I'm going to withdraw £100,000. Fine, great. You've taken your tax-free cash lump sum, you've reduced that from your pensions, and let's say you've paid off your mortgage. You pay off your mortgage, that's gone, that's then out of the equation. You need to make sure you reduce this to zero, because then you're not getting any additional tax benefit there. You need to reduce this to zero. Or if you took £50,000, let's say you took half of your tax-free cash lump sum, what you would do then is you would just put this to 12.5%, which rounds it up rather annoyingly to 13%. Let's just change that so we can see the decimal. So that means that you've got that amount left. So let's just put this back up to 25. Oh, sorry, 25. So yeah, guys, that is pretty much it. We've walked through all these different examples here. We've looked at how you can use sort of bed and ISAs and things like that. So really, what you need to do is firstly put in your information, make sure that looks okay, get it as accurate as possible, as it is right now, as you are right now, and given the income that you want in retirement, and then make a copy, make another copy of this, and then start to play around. Then start to play around with different ways that you could approach things, different ways you could be saving money, different ways you could be spending money, different times you might want to retire, in terms of part-time work, rental income, all these different things. And what it will then allow you to do is to jump back to the old model, look at the old model, look at where you are right now, and look at where you want to get to be. Now that will save you having to keep going, experimenting and then changing everything back, and then experimenting and then changing everything back. So you can have an experimental sheet, and then you can have a as you are now sheet, and you can explore this. And as I said, guys, the most valuable thing that you're going to get out of this is really, okay, a rough indication of whether you're on track or not, but don't take this as verbatim. Don't take this as, oh my God, I'm screwed. Like I'm not going to be able to do anything now. I'm totally off track. Or oh, fantastic! It looks like I've got more than enough money than I'd need. I'm therefore on track to achieve my retirement goals. I'm going to retire today. Please don't do that. Please don't do that. This is really just a rough model that I have built, and do not make any decisions just based on this. However, you're going to get a huge amount of value from playing around with these variables, from playing around with these assumptions of things like risk, like investment fees, retirement dates, different amounts of income that you could have, different amounts of income you could draw down over time. That is going to be really, really, really valuable, because there are so many different ways that you could go about achieving this. And I think one of the big things that people have is that they often can calculate how their assets are likely to grow over time when they create these models, but they don't really think about how you have both additional expenditure and have different levels of expenditure over different times, and also different levels of income over different times. Those are the real added values that you can add, that you can put in here, and you can see that how for this, in this example here, we've got someone drawing £40,000 a year from the time that they retire from a 600k pot. That's a lot of money that they're drawing out of there. That's almost sort of 6-7%. Or sorry, they're not drawing that amount out. That's at their maximum income. That's the max. Well, they are actually when they start at 55, they're drawing £40,000 a year straight away, which you might be like, that's like 7 or 8% of the value of the portfolio. That's massive. That's enormous. But the reason why we can do that, and the reason why we still end up with loads of money, is because we've got all these other little bits that we've got to think about. We've got this defined benefit pension coming in. We've then got reduction in expenditure at age 76, which most people do. So that's what you're going to get the most value out of this. So please, guys, use this as much as possible. Try and break it. Let me know if it does break. Give me feedback down in the comments. I want to know any features that you want to see, any ways that you weren't really able to sort of show the full accuracy of your picture, and how we might be able to customize this to make this better. But with your help, with your feedback, over time, hopefully we can make this into a really, really useful tool for everybody to use. Thanks, guys.